What's up traders, Tom here with another video. Today we will be discussing our technical levels for the S&P 500, NASDAQ and also Apple, as Beijing has now threatened to blacklist American companies as the US moves to cut off Huawei. We will also be discussing the current pricing of markets and whether the stimulus measures are enough to hold the markets where they are currently. Stay tuned. So I'd just like to start by giving the trading community a special thank you for helping us reach 5,000 subscribers. And of course, if you're enjoying our content, make sure to subscribe and hit that bell to receive daily financial videos on the markets. So I want to start this video by talking about the amount of stimulus that is currently in the system in terms of supporting the economies by GDP. So here we have a chart, and this chart just shows you the enormity of some of the countries' responses. Now, as you know, I'm Australian, so we're sitting here at around 10% of GDP supplied in fiscal stimulus so far. The US is slightly ahead of us, even though, of course, it's a lot more money because your economy is so much bigger. But Japan has actually been the one that has had to form the most amount of fiscal stimulus to get through this. This is interesting because number one, the breakout in Japan is nowhere near as severe as other countries like Brazil and the United States and others, but it shows you what happens when you go down the process of beginning quantitative easing and beginning a policy and you're so deep into that money policy. In recent videos, we've talked about Japan being, let's call it, subject one. And subject one was the first economy to ever try fiscal stimulus for a huge amount of time and then get so deep into it that they cannot get out. And we made a great video about this, which I'll put above if you haven't seen it yet. But Japan is really the story that I think I'll be talking about more on this channel in terms of what we start to see happening in the United States, the UK, Germany, Australia, Canada moving forward. And it's probably going to be the best forward predictor for what we see in terms of further stimulus, further monetary policies moving forward. I think that's why this chart is so powerful. Well, of course, in the recent meeting, Jerome Powell said that the Fed had more tools in its arsenal if it was needed in the future. And that's why if you're a bear in this market, while it may pay to be a bear for a certain period of time, eventually the Fed will probably step in with further policies and further help along with Congress. So do be careful if you're a bear. While I do have a negative sentiment on the indices, I do still hold longs. And of course, I'm one of those people that long term is bullish and for the shorter term is bearish or has a negative sentiment on the indices. So just be careful about what you're trying to do and what you're trying to achieve, because the Fed has made it perfectly clear during this current crisis that they're prepared to do anything, and they will step in over time as the market reaches certain points. That does not change the short-term case, though, of bearish sentiment being probably the most likely course of action. So another chart I wanted to bring up was the wealth inequality in America, and this is happening all around the world right now in terms of the amount of people that are owning shares and the amount of liquidity that is actually in the market. So it's turned out that 0.1% or the richest Americans in America are now own more shares than the bottom 80% of all people in terms of market size. And this is a bit disturbing because you can see in the 1970s, the wealth gap, where the wealth gap went after the 1970s, and of course, what has happened now where the 0.1% has become incredibly rich again. And this has happened maybe before, but it's never been this bad in the last really 40, 50 years. And this chart really shows you that. It also shows that the top 1% has done incredibly well over this time, while the rest of Americans are unfortunately suffering. And I think this is going to become more of a problem as we move forward, because with any crisis, like what we saw in the GFC in 2008, the equality became worse. So if we look at the equality over time, and this chart is a bit older, it's just getting worse. And that is going to happen again since we've seen these terrible statistics of how many people are unemployed. And there could be long-term social ramifications for this, along with liquidity thinning, because most of the shares are owned by a very small amount of people. I think the actual statistic is 16% of shares are owned by 80% of the people, and the rest is owned by the other percentage shares. So it's a pretty big wealth divide, and this will become a story in the future, and I think that's quite unfortunate. So before we look at the Apple shares, we need to just quickly look here. Futures are sliding as Beijing threatens to blacklist American companies as the US moves to cut off Huawei. Now, this is so important because this is the rise in tensions between America and China in this trade war that's been going on now for well over 18 months. Recent weeks, we have seen this escalate time and time again, and it's now starting to take an effect on the markets. And whether people want to admit it or not, I believe this is going to be one of the catalysts. But like any good market crash, you never see it, and they always use a strange reason for why they're going to sell it off. So right now, we are seeing Apple, and we'll bring that chart up right now, pre-market starting to close down. So it's actually at around $300, just above $300 pre-market into the market open. I've drawn this trend line here because it's actually been an incredible trend line that has now or will probably break today if the market stays negative on Apple. And 300 is always a big psychological number. We've mentioned that we're looking to the biggest tech stocks in the market as indicators or early indicators of serious bearish sentiment. So if Apple can remain short and it remains under this trend line, this could be one of the trigger points that we've been looking for in terms of a broader sell-off. This trend line is incredibly strong. Look at the buying pressure that's happened since the March lows on 23rd and 20th of March. So incredible buying pressure, incredible percentage. Congratulations to anyone that's been in Apple. But that trend line is now about to close under due to the trade concerns. And I think it's a very important chart of the day for us to be looking at in terms of sentiment. That'll bring me to the NASDAQ. So we had this trend line up yesterday. This is the futures market because I'm here pre-market looking at it. As I mentioned, I prefer to look at the real market in terms of closes, but I want to just make sure that everyone's aware of this trend line, and more importantly, if the market is able to break to a new lower low and close, it really signals weakness across the board. Now, Apple pre-market is definitely helping to short off the NASDAQ, but what we are starting to see is that negative sentiment come in with concerns over trade. So this trend line is one to watch, one to have in your charts, and definitely set alerts for. The next one, and the most important one, and probably what everybody is here for, is the S&P 500. So we've mentioned this one a few times. We've mentioned that we're looking at the real market close and not the futures close on this. And yesterday it looked like the bears were going to win. And then of course, the strong bulls have come in and pressured it up. So 2,800 is the close that we want to see a close low on before we consider that the bears have now won, at least in the short term. A few people asked, where does the market go after this? Well, the first stop for the market is generally going to be the distance of the double top pattern. So that would push the market into around this 26 kind of 50 area psychological point. And then of course, if it was to get past that point, you would see 2460 and then potentially new lows. Goldman sees around 2,400. I would think there's a lot of buying pressure there. My bigger thing is to go back to the NASDAQ and to consider where the huge buying pressure is. And I think the huge buying pressure for the NASDAQ is around in this zone here, this 8,000 to 8,200 zone. So I'm not saying it's going to be the deepest pullback initially. There's going to be a lot of buying pressure here because of the serious level of resistance that was had, and that will turn into support as we call role reversal. I think this is going to be the fight where the bulls come in and potentially the Fed even steps in at around this zone, starts buying more bonds, makes an announcement. We'll have to see. But if the shorting does begin, these are technical levels that do make sense for the market to get to. The last point I want to mention was, of course, conversation is now changing from liquidity to solvency. So we have here a chart, and this chart basically shows a few things. And the big one is bankruptcies. So we're talking about effectively the unemployment rate is really, really high. And we can see where the unemployment rate was during the GFC, and of course where the bankruptcies started filing in. So we had a lot of bankruptcies coming off the 2003, 2004 area, and then we had a huge amount of bankruptcies coming from the GFC. Now we're currently sitting here, but the expectation that bankruptcies will reach around this level here is quite high. So this is generally the expectation of what will happen with a lot of these companies that are being saved, or the zombie companies. So solvency is now becoming the question. We will cover this more on the channel in greater depth, but I think it's one where if you haven't read on it or you don't understand it, either keep watching and subscribe, and of course hit the bell, or you can look this up. So hopefully you found this video helpful today. If you did, make sure to like, comment down below, and of course subscribe and hit that bell to receive more daily content about the financial markets. Happy trading, everyone. See you in the next video. Bye.